2022 has been nothing but house of pain. May it be Omicron, interest rates, inflation, or tension between Russia and Ukraine. Feels like there's a surprise waiting for us every other week. Surprises aren't good for stocks. For the year, S&P is down almost 8%, while Nasdaq is down 13%. The question is, when will this end? Hey friends, welcome to the channel. My name is Raj, and on this channel, I talk about personal finance, investment ideas, and all things money. These days, macroeconomic and geopolitical news are making headlines. Most of these headlines is creating uncertainty, which has led to a broken stock market. In this video, I'll try and make some sense out of everything that is going on around us. Talk about if and when it makes sense to buy the dip, a question I'm trying to answer personally. Let's start with the obvious. Economy is strong and inflation is at a 40-year high. An average family is paying $3,000 more annually. Fed is about to raise interest rates that is expected to slow things down. This has destroyed hypergrowth stocks, since higher interest rates is not good for companies that rely on future earnings. More on this in these videos. Broader stock market is down as well. There is this uncertainty in terms of how much the Fed will raise and how fast. Gradual rise in rates is expected and easier to consume. Too fast create noise that stocks don't like. Geopolitical tension between Russia and Ukraine is also turning out to be a reason to sell stocks. While such news should mostly impact commodity prices and treasuries, it does create short-term uncertainty. So the question now is, when will the market stabilize or bottom? And when should we be buying the dip in stocks? Now, I wish I had the crystal ball, but I don't, and have no clue when sanity will return in the stock market. But what we have is data that can help us draw some meaningful insights. Let's investigate 3 data points: impact of rate hike, impact of geopolitical events, and typical drawdown patterns. Here is data from last 4 Fed tightening cycles. On an average, tightening cycles lasted 17 months from the first rate hike to the final rate increase, with an average rate increase of 2.69%. In 3 of the 4 tightening scenarios, volatility was higher in the 12 months following the rate hike than the 12 months preceding the event. But increased volatility doesn't necessarily mean a market decline. Despite the increased volatility, S&P had a positive 12-month return following the first rate hike, averaging 7.13%. Key takeaways: expect increased volatility, short-term pain in stocks, but will be fine in the medium term. Tensions between Russia and Ukraine has also been a cause of worry for the market. If you look at the data, historic events has caused some short-term drops, but not by a lot. S&P dropped an average 4.9%, bottomed within 19 days, and fully recovered within 43 days on an average. The average 6-month gain following 28 such events was 2.3%. Not bad. Key takeaways here: drops are short-lived. Recovery is swift. Let's take a broader perspective. If we go back all the way to 1928, in 59 of 94 years, losses were excess of 10%. In 24 of 94 years, losses were excess of 20%. Average intra-year drawdown was 16.5%. If we just look at recent data from 1990s, where S&P has dropped greater than 5%, drawdowns lasted an average 56 days with 12% drop, and recovered within 88 days on an average. Final data point, sharp declines are always followed by major gains. 2020 pandemic drop is the latest example. Market dropped 34% but was up 75% a year out. You don't want to stay uninvested when markets rebound. Key takeaways: intra-year drawdowns does not mean the year is a wash. Buying such intra-year drawdowns has resulted in major returns for investors. In a year where we expect the Fed to tighten, we will experience increased market volatility. While we will see some pain in the short term, history suggests we'll be fine in the medium term and beyond. Geopolitical events are more a bump on the road than anything else. S&P is approaching correction, while Nasdaq is close to a bear market. If history is any indication, market is giving us an opportunity to buy low. Treat this as an opportunity to buy, since major drops are always followed by violent rallies. And you want to stay invested when that happens. Long story short, you have to buy the dip at regular intervals. I usually don't try and time the market. Instead, buy the dip when QQQ drops 10%, 20%, and 30% from all-time highs. Something I have come up with, it works for me. Now, you could short the market on the way down, but that has not worked for me. I usually end up missing the shorting boat. Take a look at this video where I talk about some strategies I use to manage volatility. If you've been in the market long enough, you know this is not something new, but more a phase that will eventually pass. The key is to have a plan, buy the dip at regular intervals, and most importantly, stay invested. Thanks for watching. Thoughts, comments? Until next time, hang in there.